In 1980, a real estate agent showed a house for $63,700. The median household income in America was $21,020. Do the math, that house cost about 3 years of what the average family made. A regular person on a regular salary could actually afford it. Today, that same house in that same neighborhood costs $419,300. Your median household income is now $83,730. That house costs 5 years of your income. But here's what's interesting. Your salary didn't grow 5 times faster than inflation. Something else changed. The game itself changed. It wasn't just that houses got more expensive. The entire way housing works as an economic system transformed. And if you've wondered why your parents could buy a house at 28 and you're wondering if you'll ever buy one at all, this is the story of how that happened. Let me take you back to 1980, not the 1980s as you remember it from TV shows. The actual economic reality of buying a house. Picture John and Mary. John's 28. He works at an automotive plant near Detroit. It's a good job, he makes $22,000 a year. Mary stays home with their 2 kids. That's it, one income. One modest salary. John and Mary want to buy a house. They've saved for 3 years. They have $12,000 down. That's about 20% of the house price, which is what banks expect. It's normal. They walk into a savings and loan, not a mortgage broker, not an online platform, an actual savings and loan where they know the teller and they sit down with a loan officer. The loan officer pulls out a piece of paper. Mortgage rates right now are high, really high, 12.7% on average. Some months they peaked above 15%. John's nervous. Mary's nervous. But the loan officer walks them through the math. On a $51,700 mortgage, he says, at 12.7% for 30 years, your monthly payment is $624. John makes about $1,833 a month after taxes. $624 for the mortgage. Property taxes and insurance add maybe $150, so total housing cost is about $774 a month. That's 42% of his take-home pay. Tight? Yeah, but doable. He can make it work. Here's what's important. Nobody tried to sell John and Mary a house they couldn't afford. There were no complex mortgage products. No interest-only loans. No stated income loans. The system had guardrails. You saved 20%, you proved you could afford the payment. You got a 30-year fixed mortgage at a rate that was locked in forever. The house wasn't an investment. It was a place to live. And it was achievable for a factory worker. So what changed between 1980 and 2024? Why is that same house $419,300 and a factory worker can't touch it? It wasn't one thing. It was a series of economic decisions and incentives that stacked up over 44 years. Let me walk you through the big ones. The housing bubble and 2008 first. You have to understand the 2000s. Lending standards got loose. Really loose. Banks started approving people for mortgages they couldn't afford. Subprime lending exploded. Anybody could get a mortgage, bad credit, no income verification, nothing down. Lenders didn't care because they were selling those mortgages to Wall Street within days of originating them. When people with no business owning homes start buying, what happens? Prices go up. Demand goes up. Supply can't keep up. House prices doubled between 2000 and 2006. Then, in 2006 and 2007, the whole thing cracked. Subprime borrowers started defaulting. The mortgages were bad. The banks holding them faced catastrophic losses. Then came the panic. Credit froze. People stopped buying. Foreclosures flooded the market. By 2010, there were hundreds of thousands of empty houses. This is where the story gets interesting and where the system actually changed. Institutions enter single-family housing for 100 years. Single-family houses were bought and sold by individual families. It was just how it worked. Regular people bought homes to live in. Institutions didn't exist in this market. Then, in 2012 and 2013, something new happened. Investment firms, private equity firms, hedge funds, real estate firms realized they could buy thousands of these foreclosed houses cheaply, rent them out, and collect monthly rent checks while the properties appreciated. Blackstone, one of the biggest private equity firms in the world, created a company called Invitation Homes in 2012, specifically to buy single-family homes as rental properties. They didn't want to live in these houses. They wanted cash flow and appreciation. Meanwhile, the government actually encouraged this. The Federal Reserve wanted the housing market to stabilize. The Federal Housing Finance Agency, which oversees Fannie Mae and Freddie Mac, created programs to sell foreclosed homes in bulk to institutional investors. Fannie Mae even gave Invitation Homes a $1 billion loan in 2017 to buy more houses. So the government, trying to stabilize housing, actually helped institutions get into the single-family rental business. The financialization, but here's where it gets really important. In 2013, a company called Chimera Investment Corporation pioneered something called single-family rental securitization. That's a fancy way of saying they took cash flows from thousands of rental houses, bundled them together, and sold them as securities on Wall Street. What that meant, owning rental houses became just another investment on a balance sheet, just like stocks and bonds. This pulled capital into the market. Investors who had no interest in actually being landlords could now buy housing-backed securities. Capital that used to buy other things started buying houses. That pushed prices up. But also, the real constraints. Now, here's what's important. Institutions only own a small part of the housing market. According to the Government Accountability Office in 2024, institutions own about 0.6% of single-family homes nationally. 0.6%, that's it. So why are people so focused on institutional investment if it's less than 1% of the market? Because it's concentrated. In Atlanta, institutions own about 15 to 25% of rental houses. In Jacksonville, similar numbers. In some neighborhoods, it's much higher, but nationwide, it's small. The bigger issue isn't institutions, it's that the supply of houses didn't grow. The demand for houses grew, but new construction couldn't keep up. Zoning restrictions, labor costs, regulations, they all slowed new building. When demand grows and supply shrinks, what happens? Prices go up. The accumulation, but the real shift is this. From 1980 to 2010, housing prices roughly tracked inflation plus a little bit. A house was shelter. You might hope it went up in value, but that wasn't the main point. By 2010, housing became an asset class. People started buying not just to live in, but as an investment. Your house wasn't just shelter anymore. It was your retirement plan. It was supposed to appreciate aggressively. That changed the game. When houses are shelter, prices are determined by what people can afford. When houses are investments, prices are determined by what investors think they'll be worth next year. And investors will pay more than ordinary people can afford. That's the fundamental shift. That's when John and Mary's pathway became inaccessible. Let me show you exactly what changed with hard numbers. Price and income in 1980. Median home price, $63,700 median household income. $21,020 price-to-income ratio, 3.03 years. In 2024, median home price, $419,300 median household income, $83,730 price-to-income ratio, 5.01 years. You need almost 2 more years of salary to buy a house now. That's not a small change. That's a fundamental difference in accessibility. But wait, interest rates tell a different story. Let me show you. The interest rate paradox in 1980, mortgage rates were 12.7% on average. Really high. Your monthly payment on that $51,700 mortgage was $624. In 2024, mortgage rates are about 6.7% on average. Half the rate. So you think buying a house is easier now, right? Lower rates mean lower monthly payments. Here's the thing. In 2024, on a $365,000 mortgage, the average after a down payment at 6.7%, your monthly payment is $2,422. John makes roughly $1,833 a month after taxes in 1980 money. $624 was tight but possible. In 2024 money, someone making the equivalent of John's job needs $8,000 a month after taxes just to comfortably handle it. $2,422 mortgage plus taxes and insurance. That's roughly $120,000 a year salary. Factory workers don't make $120,000 a year anymore. So yes, rates are lower. But the absolute price is so much higher that lower rates don't help. In fact, lower rates just pushed prices higher. Because buyers could afford bigger monthly payments. So they were willing to pay more for the house. Here's another way to see it. The down payment burden. In 1980, John saved $12,000 over 3 years. That's $4,000 a year on a $22,000 salary. That's about 18% of his gross income. His wife wasn't working. In 2024, the median down payment is about 12% of the house price. That's $50,316 on an $83,730 household income. Saving $50,000 would take about 7 to 8 years of saving before taxes. In reality, people in 2024 are putting down less often 5 to 10%, which requires less upfront capital but means higher monthly payments on a bigger loan. Home ownership rates. Now here's something interesting. Home ownership rates haven't changed as much as you'd think. In 1980, about 66% of Americans owned homes. In 2024, it's about 65%. So the same percentage of Americans own homes. But it tells you nothing about who owns them and whether the next generation can. Age of first-time homebuyers in 1980, the median age of a first-time homebuyer was 32 years old. In 2024, it's 38 years old. Think about that. Your parents were done with the big life purchase at an age when you were just starting to think about it. 6 years difference. For people aged 25 to 34, home ownership has collapsed. 1980, about 50% of this age group owned their home. 2024, about 37% of this age group owns their home. That's a 13-point drop. That's significant. The rent burden. Here's something else important. While ownership rates stayed about the same, renting got harder. In 1980, about 35% of renters were cost-burdened, meaning they spent more than 30% of their income on rent. In 2024, about 50% of renters are cost-burdened. People who can't afford to buy are also getting priced out of renting. That's a squeeze from both sides. Purchasing power of $1. Let me put it a different way. In 1980, $1 could buy a certain amount of house-related goods and services. According to the Bureau of Labor Statistics, $100 in 1980 is equivalent to about $380 in 2024, when you adjust for overall inflation. But housing didn't just inflate with everything else. It inflated faster. Housing prices have gone up about 73% more than you'd expect from general inflation alone. That's the real story. It's not that everything got expensive. It's that housing got disproportionately expensive. So what does this actually mean in real life? How did this economic shift change what people's lives look like? Your parents' path, if they bought a house in the 1980s or before, had a pretty clear path. High school, get a job, save for a few years, buy a house in your late 20s or early 30s, raise a family, pay off the mortgage by the time you retire, use the equity for retirement. It was achievable. Not easy, but achievable. By the time you hit 35, you were a homeowner. You had equity building. You had a sense of stability. Your children's path, your children, if they're younger, face a completely different math. If they get a good job at 24, they're making maybe $50,000. If they want to buy a house, that $419,300 median price requires either save for 8 to 10 years first, so they're 32 to 34 when they can afford a down payment, or both spouses work and combine income, or get a family loan for the down payment, or rent indefinitely. For your parents, option 1 wasn't necessary. They could buy in their late 20s while still raising kids and building a life. Your children have to choose between saving for a house or living their life. Those aren't the same choices. The psychological impact, this matters beyond just the numbers. There's a psychological component to homeownership that people in your age group understand instinctively. For your parents' generation, buying a house was a rite of passage. It meant you were an adult. It meant you had made it. It meant you had a place that was yours. For people trying to buy now, it feels like an impossible mountain. And if they can't buy, there's this underlying sense of failure. Even though it's not personal failure, it's systemic. The game changed. But many people don't understand that intellectually. They just feel it. They feel like something went wrong with them. Generational wealth. There's another impact here that matters: wealth creation and generational transfer. Your parents' generation built wealth primarily through homeownership. They bought a house, it appreciated, they paid off the mortgage, and suddenly at retirement they had a massive asset to live off of or leave to their kids. That's how middle-class wealth was built in America. From 1945 to 2000, you didn't need to be smart about investing. You didn't need to be rich. You just needed to buy a house and wait. If your kids can't buy houses or buy them so late and with so much debt that appreciation doesn't help, then the primary wealth-building mechanism for the middle class disappears. That's generational. That affects everything downstream. The rent trap. Let me illustrate this with actual math. John's granddaughter makes $60,000 a year. Option 1. She saves hard for 10 years, living modestly. She rents. Rent in her city is $1,400 a month. Over 10 years, she pays $168,000 in rent. She saves $100,000 for a down payment. Total, $268,000 spent on housing to get to homeownership. Option 2. She just rents forever. She never builds equity. When she's 65, she has no house, no equity, and her retirement depends entirely on savings and Social Security. Her grandfather? He paid $624 a month for 30 years. Total, $224,640 over 30 years. At the end, he owned it free and clear. That was his retirement security. Different math, different outcome. Regional variation. It's also worth noting that this isn't uniform across the country. In some parts of the Midwest, a house still costs 3 to 4 times annual income. You can still buy at 28 or 30 if you have a decent job. In some parts of the West Coast, California, New York, homes cost 10 to 15 times annual income. It's essentially inaccessible to regular workers. Where you live increasingly determines whether you have access to wealth building through homeownership. That's a change from your parents' era, when this was possible almost everywhere. Now, before you think all of this was inevitable, that housing had to become unaffordable, I want to show you that other systems made different choices. Here's the thing, they also have strong apprenticeship systems. People can get good-paying jobs without 4-year college degrees. Switzerland has very strict rules about foreign investment in real estate and second homes. Institutions can't just buy up houses the way they can in America. Housing is tightly regulated. They're not used as speculative assets the way American homes are. Prices appreciate slowly, predictably. Canada. Canada let institutional investment in single-family housing happen similarly to the US. Guess what happened? Housing prices in Toronto and Vancouver exploded. They're now facing the same affordability crisis that American West Coast cities face. So they're actually clamping down on foreign and institutional investment now. They're closing the barn door after the horses escaped. The trade-offs. Here's the important part. Every approach has trade-offs. Countries with strong rent controls have less housing construction and less innovation in housing. People stay in the same apartment for 30 years. Countries with strict foreign investment rules have less capital flowing into the market, which means less development in some cases. America's approach of open markets and deregulation created a lot of housing and a lot of flexibility. It also created speculation, inequality, and accessibility issues. None of these approaches is pure good or pure bad. They're just different choices that create different winners and losers. The point is, America chose the path it took. It wasn't inevitable. And those choices had consequences. Let me summarize what actually happened. In 1980, a house was shelter. It was something a regular person could buy with one income and hard work. The path was clear. Work, save, buy a house, pay it off. That path still technically exists. You can still buy a house, but the entry point moved. It moved from your late 20s to your late 30s or early 40s. It moved from one income to 2 incomes. It moved from saving for 3 years to saving for 8 years. It moved from an achievable goal to a daunting challenge. Why? Several things happened at once. Lending standards loosened in the 2000s, creating a bubble. That bubble burst. Institutions entered a market they'd never been in before. Capital flowed into housing as an investment asset class. Construction couldn't keep up with demand. Zoning restrictions prevented supply from responding to prices. Older generations bought multiple properties for investment. Interest rates went up, then down, and the effects rippled through prices in complex ways. No single villain here. No conspiracy. Just a bunch of economic incentives and decisions that stacked on top of each other, each one pushing prices higher. The result? Your parents could afford homeownership. Your children face a 50-50th shot. That's not nostalgia talking. That's data. That's the actual economic math. And here's what matters. Understanding this isn't about predicting the future. It's not about whether housing prices will go up or down. It's about understanding your own economic reality. If you're 65 and you paid off your house, you probably don't fully understand why your 35-year-old child is still renting. It's not laziness. It's not poor financial habits. It's that the game changed. If you're 35 and you're renting, you're not failing. The economic accessibility shifted. You're dealing with a different set of rules than your parents did. Understanding that difference, that it's not personal, it's structural, is actually powerful. Because it helps you stop blaming yourself and start thinking about what's actually possible in the world as it is, not as it was. Your parents' advice, just work hard and you can buy a house, comes from a true place. They live that reality. But they're giving you a map for a territory that doesn't exist anymore. The question isn't whether housing is right or wrong or good or bad. The question is, what do you do now? What are the actual choices you have? How do you build security and wealth in an economy where the rules are different than they were for your parents? That's the question worth asking. Let me summarize what actually happened. In 1980, a house was shelter. It was something a regular person could buy with one income and hard work. The path was clear. Work, save, buy a house, pay it off. That path still technically exists. You can still buy a house, but the entry point moved. It moved from your late 20s to your late 30s or early 40s. It moved from one income to two incomes. It moved from saving for 3 years to saving for 8 years. It moved from an achievable goal to a daunting challenge. Why? Several things happened at once. Lending standards loosened in the 2000s, creating a bubble. That bubble burst. Institutions entered a market they'd never been in before. Capital flowed into housing as an investment asset class. Construction couldn't keep up with demand. Zoning restrictions prevented supply from responding to prices. Older generations bought multiple properties for investment. Interest rates went up, then down, and the effects rippled through prices in complex ways. No single villain here. No conspiracy. Just a bunch of economic incentives and decisions that stacked on top of each other, each one pushing prices higher. The result? Your parents could afford homeownership. Your children face a 50-50th shot. That's not nostalgia talking. That's data. That's the actual economic math. And here's what matters. Understanding this isn't about predicting the future. It's not about whether housing prices will go up or down. It's about understanding your own economic reality. If you're 65 and you paid off your house, you probably don't fully understand why your 35-year-old child is still renting. It's not laziness. It's not poor financial habits. It's that the game changed. If you're 35 and you're renting, you're not failing. The economic accessibility shifted. You're dealing with a different set of rules than your parents did. Understanding that difference, that it's not personal, it's structural, is actually powerful. Because it helps you stop blaming yourself and start thinking about what's actually possible in the world as it is, not as it was. Your parents' advice, just work hard and you can buy a house, comes from a true place. They live that reality. But they're giving you a map for a territory that doesn't exist anymore. The question isn't whether housing is right or wrong or good or bad. The question is, what do you do now? What are the actual choices you have? How do you build security and wealth in an economy where the rules are different than they were for your parents? That's the question worth asking.